We're finally here. The real estate investing heavyweights debate. We are officially live. I want to make sure that you guys can hear me, and we'll wait a minute or two to let people file in here. I know we've been talking for about 10 minutes already, and I wish people can hear some of the smack talk going on already between Tim, Rob, and Dave. What's going on, gentlemen?
Hey, good.
Excited to be here, man. Thanks for putting this together, Pardo.
Yeah, man. Yeah, no, thank you guys, man. I want to, I genuinely thank you guys. I consider you guys all friends, and you guys are thought leaders. You guys are crushing it in your business, and I'm excited to do this. It was kind of a crazy idea, and it seems like it's caught some buzz. So really, really looking forward to this debate.
Happy to be here. I don't know if I'd call it a debate. Let me try to think.
Here we go. Looks like we got about 30-something people on live already. So, guys, do me a favor. Let me know you can hear me. Comment where you guys are coming in from. We're going to get started in about a quick minute here. It looks like you guys can hear me. Somebody says multifamily team in the house already. So this should be interesting, guys. My friends, I was just thanking the gentleman here for participating in this. I want to thank you guys, because without you guys watching and supporting and commenting and engaging, this wouldn't be a possibility. So I really genuinely appreciate the time. We got Roddy in the house. Let's roll.
So
Alex Jandick from St. Pete. Excited for this. So guys, we got a lot of people on already. So having said that, I want to kind of share some housekeeping. This isn't about me. I don't want to talk for more than a couple of minutes, but I kind of want to just like lay the groundwork, let you guys know why we're doing this. And then we're going to hop into the debate. I'm going to let you know how this is going to work. So these guys are all givers, right? These guys are go-givers. They understand the importance of giving back. And so one of the reasons we're doing this is because we want to educate, inspire, and I believe you guys will be entertained. So that's one of the reasons. The other reason is we thought that this would be a really, really good opportunity for us to raise awareness and raise money for a particular charity that's kind of near and dear to my heart, a charity that I've been supporting for a number of years now. A bunch of families live just in poverty in Guatemala. And I've had the opportunity to go there every year and just meet with the children and meet with the families. And so any money that you guys decide to donate, I'll let you guys know how to do that. In fact, we're going to make it kind of fun. So you guys are going to vote for who's going to win the debate. You'll text the word single or the word multi to a particular phone number that I'll share with you guys a little bit later on in the debate.
Multi.
I knew Rod was going to say something. And by the way, guys, for your donation, these guys have each agreed to give you something very valuable, a valuable resource. So I'll reveal the domain a little bit later on in the live. You guys will have access to a bunch of valuable resources. And if you choose to make a donation, greatly appreciated. And if not, that's fine too. We're just grateful that you are here. So having said that, guys, this is how the debate's going to work. We could have gone in so many different directions as far as single family versus multifamily. So what we ultimately concluded was we're going to go 5 rounds plus a bonus round. I'm not going to reveal what the bonus round is just yet. You'll have to stick through. But here's how the 5 rounds are going to be. We're going to have one baseline question. Here's the question. Which asset class is superior in the following areas? Round 1, we're going to cover acquisitions. Round 2, we're going to cover dispositions. Round 3 is financing. Round 4 is management. And round 5 is construction. So each side is going to have 5 minutes to state their case as to why they feel single or multi is the superior asset class when it comes to those areas. Each side will have 5 minutes, and then I'm going to kick it over to the other side for a 2-minute rebuttal. That's how we're going to go each round. Gentlemen, any questions on your end?
No, sir. Keep us in check, buddy.
Is there a way that the single family guys can tap out early? Is there
Right. Yeah.
What's the safe word for them?
You guys are too much. Guys, before I kick this over to the debate, we're planning on going 90 minutes. Make sure that you stick with us. I will keep us on track. If you see me holding this up, that means that whoever is speaking has 1 minute to wrap it up. I'm going to do my best to keep us on time, 90 minutes. If you have questions, start putting them in the chat box as they come up, because we're going to do 30 minutes of live Q&A after the debate. So we want to make this interactive. We want to make this fun. Any questions you have, Kevin Bupp is already saying in the house. Multifamily is going to win by KO.
Oh, good Lord. Should have had him in here.
Mobile home. Save it for the mobile home part.
Yeah, there you go. Hey, but it's not all multifamily. I got several people saying single family is going to bring it. So you guys might be surprised.
Really? Okay. One thing I want to add, Alex, you might want to add like a COVID conversation as well. Survivability through COVID. That might be fun. Maybe in the Q&A if we have time. Just a thought.
Sounds good. Great suggestion. Guys, we're going to get rocking and rolling here with the debates. So why don't we kick this off? We're going to have single family go first. Round one. Which asset class is superior when it comes to acquisitions? Go for it.
Sure. I'll start us off. So first, I just want to thank you, Alex, and all of the Flip Empire and all the viewers and listeners. It's a great opportunity. And then also thank the opposition, Mr. Rod Cleef and Tim Bratz. Thanks for doing this. I got a tremendous amount of respect for both of you. I was just sharing with Rod. I have his book right here on the bookshelf, and I have been to the Bratz Manor and have been trained extensively through the legacy mastermind and everything Tim's doing. And I want the listeners really to know at the end of this, real estate as a whole is the right business to be in. So any business where you can acquire an asset, you can, get cash flow, you can get appreciation, and you can use leverage to acquire this asset is the right business. So Rob and I today are going to share some things on really every point from acquisitions, dispositions, financing, management, and construction on why single family is just a little bit better. And I want to start out really with just supply and demand, because basic economics of any business, whether it be a lemonade stand or a real estate company, basic economics come down to supply and demand. And I pulled some statistics for you guys. Post-pandemic, single family new construction starts have made a complete V-shaped recovery. In fact, it's 7.2% higher than the pre-pandemic highs. It has grown that much. Multifamily new construction right now, and brace yourself for this, everybody, it's staggering, is down 42.4%. The reason it's down that much is the giant funds, the big billion-dollar new construction, they build these things, they've pulled their money out. They've stopped some of these construction projects halfway through because the demand is down in the toilet. I want all of the listeners right now to envision themselves having to work from home, having 3 kids now they got a homeschool. You're trapped in this tiny little apartment. So everybody, demand is at an all-time low. And Rob, share more about the risk factor in the multifamily space.
Well, here's what, Dave, what I want people to take away from this, and Alex, I'm glad you set this up. Guys, thanks for participating. Here's what I want to do. I go back into this business for 20 years. I've been doing this. I've been through multiple cycles. And like Dave already said, any investment vehicle, real estate, is a good choice. So get involved in real estate. If you're not involved in real estate, get involved in real estate. I think people forget about in the late 80s, the early 90s, the S&L crash and the obliteration of not only single family, but multifamily just got completely obliterated. Take us back to 2008. Multifamily, in that crash, rents plummeted. Single family rents during that crash actually rose. And it goes back to what Dave was talking about, the supply and demand. And so what I want you to think about as an investor is the number one question that any investor has to ask when evaluating an asset class. What's my worst day? And it's really a question about risk. And then how do you, if you can identify the worst day, mitigate those risks along the way? And so as we go through the next 90 minutes or so in this conversation and through each round, what I want you to do is not say, is real estate good or bad? I want you to say, what are the risks associated with each potential asset class based on the cycle, based on financing availability, based on your skill level, based on your experience, and see if you can identify those risk components, the worst day, and then mitigate against those. So that, Alex, as I set this up, is the thing that I want people to start to focus on as we dive deeper.
The biggest, one last key point here. We got a minute left. I already know Tim and Rod, they're going to make great points when it comes to scalability. Of course, it's simple. You can go buy a 100-unit apartment building, or it's going to take you longer to buy 100 individual single-family houses. they have us there without a doubt. However, the risk is far greater with this one apartment building, and the number of exit strategies, acquisition strategies, the financing is better. Everything that multifamily brings to the table, except for the scalability factor, which is actually more risk, single family can do the same thing or better.
Well, Dave, when I got into this business, when I tried to replace my income 20 years ago, when I tried to create a lifestyle, when I tried to create cash flow at an income replacing level, quit my job, I kept bumping into brick roads and I failed. And then I said, you know what? I'm just going to go create my first $1,000 in passive income. And then I stacked $1,000 bills on top of each other to get ultimately what we have today.
And I would argue a lot.
Actually, Dave, I need you to hold off on that because we're at 5 minutes on the dot. So let me kick it over to Multi. Again, guys, you can choose to rebut if you want, or this is more your
choose to rebut.
You're gonna have your opportunity for the rebuttal. So go with your opening statement. Why is multifamily a superior asset class when it comes to acquisitions?
Tim, you want to go? Or I'm like chomping at the freaking bit.
I know, like my heart's pumping. Like,
it's like come on.
Child, you know. First of all, thank you guys for answering how acquisitions is better in single family. I'm still waiting for a response. Rod, do you want to go? And then
I do. Let me say this overarching statement. Okay, I've got hundreds of students. I think we've probably 700 at this point, and I've never seen a student go from multifamily to single family. Okay, almost every student I've ever had has gone from single family to multifamily, myself included. For those of you that don't know me, I've owned over 2,000 houses that I've rented long-term. I did flipping, wholesaling, all of that stuff over the years, and I will never do another house. To follow up with that story, in 2008, I lost $50 million because I was in way too much single family, way too spread out. And I can drill down on that if you like. But the point is, you know, I'm here arguing for multifamily for a reason, because when everything was crashing for me in 08 and 09, my multifamily did just fine. In fact, nationwide, it only pulled back about 11% as an asset class. And so, you know, if you buy right, it's probably one of the safest, if not the safest, real estate you can buy out there, period. You know, single family is a great place to start for a beginner. You know, I got lazy and single family was just easy to buy houses one right after another. And so I got a little lazy. Otherwise, you know, I'd have just done multifamily. But, you know, guys, this is honestly not a fair fight. It really isn't, because, you know, I think it's common knowledge that people go from single to multi. They start small, they go larger, they want to go larger. Certainly scalability, no question. As far as risk, if you've got a house and it's empty, you're 100% vacant. Okay. If you've got a duplex, you're only 50% vacant, you know, and so on and so forth. Much, much safer from a risk standpoint. You know, we won't, you know, we'll dig into the logistics of the management and these other components of this. But, you know, maybe on the construction side, you might have an argument, although there are incredible opportunities to construct multifamily right now and bring the owner involved. But no question, you're going to get where you want to get faster. It's safer and it's higher cash flow, and it's an asset that you don't have to babysit. Single family houses are a pain in the ass to manage. They're tough to find management companies that are any good with that asset class. Much easier to find large third-party property management companies. You can buy anywhere in the country, you know. So you know, because you can hire good, competent management, and so you know, you can have someone else manage your asset. With single family, pretty much you're locked into managing yourself, because there really aren't very many good single family property management companies. You're going to get to your goals much faster, you know, and I will tell you, back in the 08 crash, 3 years after the crash, multifamily rents had exceeded pre-crash levels. That's how strong the multifamily asset class is. And you talk about, you know, demand being low. I mean, the rent collections have been fantastic, even with this COVID nonsense and the moratorium and all that crap. Collections have been fantastic, and so, you know, it's a secure, safe. And here's the other big thing in single family. you can't force the appreciation, because your values are based on comparable sales. In multifamily, your value is based on a multiple of the net operating income. So any increase to that net income is an exponential increase to the value. You know, I've got probably 3 examples where we've bumped the value to $8 to $10 million once we've completed our business plan on a single asset. So, you know, you're able to force appreciation in a massive way that you just can't do with single family. So, Tim, you got anything to add? I've got more here, but go ahead.
I mean, there's so much, right?
Right.
So, Pardo, appreciate you putting this together. You're a stud, man. One of the best people I've ever met. So, appreciate you doing that.
Yeah, thank you.
Ton of respect for Rob and Dave and Rod. So appreciate you guys. I think you guys all bring up some good points on real estate's where you need to be. Like, hands down, owning your own business and owning real estate is the best place that you can be. From an acquisition standpoint, I know that Dave's trying to downplay the scalability. Oh, they're going to say scalability. I don't think everybody understands how immense and how life-changing the opportunity of scalability is. Like, I know guys from CG who flip 300 to 400 houses every year, and they have transactional income. I own 4,200 units, and that's only 60 apartment buildings. I own 60 buildings. I've only done 60 deals in the past 5 years, and I own 4,200 doors because take a look at 100 units versus 100 houses. All right, I call the rebuttal, though.
All right, we got a minute left. Hold on here. But the other thing is,
you got a hang time, my man. We are up on 5. You're gonna have your opportunity within the 2-minute rebuttal. So,
single family is a job.
So
that's it. It's a great job. It's great money. But
here's what we're gonna do, Rob, Dave. You guys got 2 minutes to rebut anything that Tim and Rod just shared.
Right, but wait, you gave us a minute. Hold on, don't steal my last minute here. We got 30 seconds.
Hang on.
You guys have 5 minutes. 2 minutes.
Real quick, you know.
I saw a 1 minute sign go up, so we have 30 seconds left. Let me just say this: single family's a job.
We're going to get to hear Rob ramble more. It's this rambling nonsense about
single family. You guys got 2 minutes.
Okay. So one of the points that Rod made was, the management is so much better in multifamily. You've got to be kidding me. You can structure a single family portfolio in such a way where you have zero management. And they're going to talk about, we only pay 4% for our management. We pay 0% because we never get 3%. Yeah, it doesn't matter. We pay 0% because we get 0 phone calls. Right? You can structure a single family portfolio where the resident is responsible for all the maintenance because there's an ownership mentality. Try that with an apartment building. Not to mention, no one even wants to live in an apartment right now. People live in apartments simply because they have to, because they're saving up for a house. Rob, I know you're chomping at the bit about the 2008 stuff. I saw you perk up for that.
Well, I wrote down a couple of things. In 2008, Rod, you said lost $50 million in single family houses. And I don't know, was that because it was single family houses, or was that because it was over leveraged and there was too much?
I was at a 30% loan to value. It was logistics. And we'll talk about logistics when we get into management. But
go ahead, Rob.
So the other thing is, the comment was, you can't force appreciation. I teach people how to force appreciation with single family houses all day long.
All day.
And so it's not that difficult to do. There's multiple exit strategies that you can force appreciation. 100%. And it's a big part of what I teach people to do, buying in the midst of a crash and a downturn. How do you force appreciation on a single family? So based on where we sit in the market cycle today, I like the opportunity. And yeah, you can force appreciation on apartments as long as there's income. But with single family, I can force appreciation whether there's income or not, because it's the American dream and people want to live in a single family house. So whether I sell owner financing, whether I sell it on a rent to own type basis, I can force appreciation and give people what they truly want. And that is the ability to live in a single family house.
Dave, you got 30 seconds if you want to share anything.
It's simple economics, everybody. Like I said in the beginning, it doesn't matter if we're running a lemonade stand or a real estate portfolio. It's supply and demand. And if nobody wants to be in the, asset that you have, good luck having a bank financing. The first financing to go out when the banks get conservative, it's not single family financing, it's multifamily financing. And the numbers already show 42% it's down. These giant builders, they're all pulling out, guys.
All right, Dave.
Okay.
Kick it over to Tim and Rod.
Wow, it's deep in here. I need my boots. I mean, Fannie Mae and Freddie Mac never goes away, and that's multifamily financing at its best. Go ahead, Tim, if you want to. But remember this: multifamily is lifetime cash flow. It's the name of my podcast. Single family is a job. So you give single family people that illusion of home ownership through lease options or whatever. I've done hundreds of those, but the reality is, in most cases, they tear up the properties regardless. And if they've got a heavy lift on some maintenance item, they're not going to fix it, and it'll just get worse. And so, that's pie in the sky thinking with that model. Tim, anything to add?
Yeah. All right. So since we're on acquisitions, I want to talk about specifically acquiring apartments versus acquiring houses.
Great.
And when I look at this, I think of what would it take to acquire 100 houses that rent for $800 a month, or what would it take to acquire 100 apartment units in a single location that rent for $800 a month? That's what's going through my head when Alex asks these questions. And when I go and I make offers on properties, I negotiate with one seller, not 100 sellers. I go and do due diligence on one roof, not 100 roofs, one foundation, not 100 foundations. I raise money one time. I talk to the bank one time instead of going to the bank and raising capital 100 times. There are so many levels of due diligence. When I set up utilities on a property, I go and set up one water bill, not 100 water bills. I go and go and collect rent from one location instead of driving all over God's green earth to collect from 100 locations. There's just the amount of scalability there is unheard of. We're going to talk about financing and stuff, so I want to.
Yeah, financing and management and everything else, and just the huge advantages.
Guys.
Yeah, just the huge advantage there.
You can acquire the same way that you could acquire a single family, you can acquire multifamily.
No, far better.
I do direct mail. I do outbound phone calls. I do extracting of, tax liens, and you put out the same mailers. And I know, hey, you got a lot more property, but you got a lot more competition in single family because there's a lower barrier to entry.
Way more competition in multifam. It's the good old boys club. I mean,
all right, guys.
Not at all. Not at all, dude.
Round one is in the books.
35-year-old kid who picked up 4,000 units in the past 5 years. I'm not even a little boy.
Hang tight. All right, save this. We got 4 more rounds plus a bonus round. My friends, you guys watching this, here's how we're going to vote on single family, multifamily. Don't vote yet, but here's what I want to share with you guys. This is also your opportunity, by the way. If you go ahead and text the word single to 567-472-2371, you can go ahead and make a donation by texting the word single, or if you believe it's multi, text multi. Hang tight on that. Wait for the 5 rounds plus the bonus round to finish. But you can do that or go to reidebate.com. You guys will get access to all the resources and your ability to donate. Don't do that now, but I just want to go ahead and leave that there so that you guys know where to go in case you're not able to stick the whole way through. So we're going to move on to round 2, guys.
Hey, Pardo, can you give everybody like 30 seconds or 1 minute to just explain their background? I think that would be pretty valuable so everybody who's listening knows. What does Dave Payerchin do, right? I'm still trying to figure it out.
Go ahead, guys. Go ahead and do that.
Can you guys do that in 30 seconds?
Yeah. Sure. I do a lot of
brother.
videos. I'm a specialist in Facebook Live. I'm just kidding, guys. So I own and manage a single family portfolio with my business partner, RJ Pepino. Been in real estate since 2005. Licked my wounds in the crash, just like Rod had mentioned. We've been doing this a long time, and we have really acquired property in every way we possibly can, from creative strategies to every type of financing you could imagine. We do commercial loans. We bundle together single family houses and get commercial loans that these guys are going to be talking about. So really single family has allowed us to create freedom, and we've built a portfolio. We started buying here in Columbus, Ohio in 2012. And we are continuing to add assets every single week and every single month. How about you? Let's send it over to Rob.
Rob.
All right, guys.
If this was a popularity contest, Tim and Rod got us beat. Okay. I mean, look at us. We're these 2 bearded beauties here that no one even knows who we are. Thank you for that, Tim. Tim felt bad for us. Said, maybe we should introduce these guys because no one knows who they are. Thank you for that, Tim. If this was a popularity contest, they're going to win. But wait until the very end until you vote, because I think all of the listeners and viewers are going to see there's no better asset class than single family. Go ahead, Rob.
Guys, so I've been a real estate investor for 20 years. I bought and sold thousands of houses, done everything from fix and flip to buy and hold to creative deals to you name it. If there's a deal out there, I've probably done it. And if you ask me about it, I'll probably give you the address and talk to you about that specific deal. So I've done a lot of stuff. I've bought and sold in 20 different states and 30 different cities. I'm a big believer in diversification on a single family portfolio and understanding how the market cycle is impacting the performance of your portfolio and looking ahead at the potential risk and setting up against that. I also own Freedom Soft, which is a real estate investment, lead generation and automation CRM. And just another piece of the cash flow puzzle, guys. I own single family, multifamily, software, you name it. I'm a cash flow guy.
I think by the end of this debate, Rob's going to convince us all we need to be buying software companies instead of real estate.
Mr. Bratz, what do you got, man? 30 seconds.
Tim Bratz. I come from the single family realm. Started out in real estate in 2005, in construction, brokerage side of things. Started investing in 2009 once the market tanked. And I come from single family. I've wholesaled. I flipped like the retail single family stuff. I built small single family, or not small, but I built big single family portfolios. I had a turnkey business doing 80 to 100 houses a year for many years in a row. Had built up one of the largest residential property management companies in Cleveland. And during that time, I was also investing in multifamily. I've done vacation rentals, I've done land development, I've done a whole bunch of different stuff. And I've been investing in multifamily since 2012 also. In 2017, I sat back on vacation and I looked at where was I spending my time and where was I building my net worth? And 90% of my net worth came from my apartments, and it was only 10% of my time. And I thought, what the hell am I doing? What if I dedicate all my time to apartments? And I was at a few hundred units, I don't know, 400, 500, 600 units back then. And I ended up shutting down my single family operation and took my income, took my net worth to multiple 8 figures over the course of the past 2.5 or 3 years, I guess. Because I focused on multifamily real estate investing.
Mr. Rod Cleave, 30 seconds. What do you got?
Yeah. Hey guys. So I've been in real estate my whole life, 42 years. I'm 60. And many of you have heard my story because I didn't get interviewed a lot on other podcasts and, lost a lot in 2008. And it was a single family that pulled me down, even though I was only at a 30% loan to value. And, so what I discovered as I was going through that is my apartments did just fine. I had apartment complexes then too. And they pulled back a little, but they would have easily survived if I hadn't cross-collateralized them with big packages of houses. And so I started my podcast, and I'm blessed now. I've got the largest commercial real estate podcast really in the world. We over 9 million downloads. And I started coaching and teaching because I love it. And I truly do it because I love it. There's some of the hundreds of thank you cards I've gotten. And so that was about 3 years ago. And that's 3 years ago. And now my students are pushing 40,000 units that they've acquired. I've done over 1,500 with my students alone in the last 18 months alone. And so, I love the multifamily business because of its scalability. I wrote a book, How to Create Lifetime Cash Flow Through Multifamily Properties. Dave said he had it on his bookshelf. It's a bestseller. And I gave away about 20,000 copies before I put it on Amazon. But what else?
Think we're good.
Yeah,
for now.
That's it. Yeah,
we can go on. You guys are all rock stars. There's no, it isn't by chance or coincidence that I chose you guys because of the type of people you are, number one, and you guys are thought leaders and what you have accomplished and what you continue to accomplish and the millions of people that you guys collectively are inspiring. So let's move on with having said that to round 2, guys. We're going to talk about dispositions now. I'm gonna actually start with multifamily this time around, and we're going to alternate. So when it comes to dispositions, guys, why is multifamily the superior asset class?
Can I start real quick, Rod?
Yeah, buddy, you bet.
So as Rod was saying in the last round, single family it's for the most part, most people get into single family and it's transactional. They think they need to go and stockpile a bunch of cash in order to then be able to go and buy and hold property. It's not the case in multifamily. Multifamily, they actually expect you to raise capital from outside investors and syndicate the deal, and banks are totally cool with it. You try doing that on a single family. I know it's a financing side, but I want to kind of lay the groundwork. I got into multifamily. My business model is the same as I had in single family, but I just correlated it to multifamily. So I buy and I'm all into an apartment building for 65% of the after repair value. So instead of a $100,000 house being all in for 65 grand, I'm into a $10 million building for 6.5 million. If you sell that building, you have a high paying job. You know, I got to go back to work. I got to trade my time for money. It's transactional again. My model is to then refinance. It's a BRRRR method, right? I mean, it comes from single family. I use it in multifamily because it works better. And so buy, renovate, rent, refinance, rinse and repeat. And so I then go and get a 70% LTV loan, take a $7 million loan out, pay back my investors, pay off the bank loan, and I have long-term non-recourse debt in place, fixed interest rate on a 30-year amortization with a 10 to 15-year term. And so now I don't owe anybody any money. It's non-recourse debt that's in place. I don't need an exit strategy. My
lifetime cash flow
is to build wealth. I want legacy wealth long-term, and that is how legacy wealth is built. It's by buying assets and creating so much value for your tenants. It's clean, safe, functional housing where they're willing to pay you every month. That covers your operating expenses. It covers your debt service and puts cash in your pocket. And over time, as the property appreciates and as principal's paid down, you create real wealth. And it's a lot easier to do that when you have 100 units and you're focused on one building than 100 different properties spread all around.
It's a lot less work. And I will add, you know, my only comment on dispositions, because that truly is a single family, really dynamic in my world, at least as well. That's why my podcast is called Lifetime Cash Flow. It's exactly what Tim said. It's buy, refinance, give their investors their money back, get our investment back, and then hold on to it. And, you know, obviously you keep an eye on the area. If the area turns, then maybe you'll sell. But our disposition is a refinance. We hold on, we're buying these assets for lifetime cash flow. And you know, and that's why I said in single family, it's a job. You've got to, every January 1st, you go back to work and you're either involved in the management or you're buying and flipping or buying and wholesaling and or holding as well. But in our side of the sphere, it's buy, refinance, hold. You know, obviously you have third-party property management company managing it, or in our case, we manage some of ours our own as well. And just keeping an eye on the market, making sure the market doesn't turn. If the market keeps rising, then we're in it forever. If the market looks like it's going to turn, that's when we bail. But that's our disposition strategy. So
and to add on to Rod's point, Fannie Mae and Freddie Mac are mandated by the federal government to continue lending on multifamily. And that's the only asset class that they're mandated to continue lending on, regardless of what's going on with the economy. So
we're going to get into financing here in a minute. We're going to get into financing in a minute.
It's part of that disposition type thing. It's So it's always going to be there to refinance. That's not going to go away. I know Perichin's talking about construction financing, and that might have that definitely got ebbs and flows in it.
The other thing is you can't have. I mean, if you're going to talk financing,
refinance standpoint, it's always there.
You can't get non-recourse with single family either, and you can.
Doesn't exist.
Yeah, you can.
Oh, you can.
If you have a big portfolio, private money lender maybe.
Yeah, maybe a big package, low loan to value, whatever, maybe. Okay. Well. Anyway, it's again, on the disposition side, in that category for this conversation, our disposition is a refinance wherever possible, so that we can hold on to the asset. And build, there's nothing you can buy that someone else pays off. So the name of the game is to get these assets under your belt safely enough that you can refinance, have enough, raise the value, force the appreciation like we discussed, increase the NOI, net operating income to be able to force the appreciation, get the value where you need to refinance, and then just sit. You're talking to your management company once a week to make sure everything's going well. And that's it. You move on to the next one, and it's an ability to scale like nothing else.
Right on cue, my man. Right on cue. Time perfect. Rob, Dave, go ahead. You guys got 5 minutes.
So let me jump in, Dave, and then I'll toss it over to you. But I want to address a couple of things. I think both Tim and Rod said, you started with single family and you moved to multifamily. And once you moved to multifamily, things scaled up and you were able to, the name of the game in multifamily is raising capital. The name of the game in multifamily is picking good assets. The name of the game in multifamily is that credibility that you had as a single family home investor that you put in that effort to get to a level of experience and trust and credibility to go to that next level. What I would ask people to think about is, where do they sit today? What do they need to be doing today to go to the next level? I'm a huge believer. Guys, if you listen to podcasts that I've been on, podcasts that I have, I talk about scale. I'm all about scale. And so the question that I ask is, where are you today in that journey? And do you have the credibility to go raise that capital? Do you have the credibility? Do you have the knowledge to pick the right assets? Or if you raise that capital and stick your investors behind front-end debt during acquisition, how risk exposed are those investors? With these guys, probably very low risk exposure. With a lot of people that get into multifamily, I know I wouldn't give them my money and sit in an equity position behind debt and hope that it happens. And so I think about this, and I from the standpoint of, where are you in your investing career? Where are you in the market cycle? What are you trying to accomplish? When I got into the business, the first thing I wanted to do was replace my job, replace my income. And I did that $1,000 at a time. And I got to a point where then I could look beyond and say, what other asset classes can I be involved in? And so I want people to think about those risk components and where you are as an investor today. Let me toss it to you, Dave.
Well, think about this. So everything you guys are saying is great. I can't wait till we get to the finance, because raising private money for a multifamily is far riskier for the private lenders than raising against single family, a first position note mortgage. We'll get there. But, Rod made a great point. He's like, hey, we're going to plan this to keep refining and base it all on debt, and hopefully that works out. But if we need to bail, we'll sell. Well, who would you sell to? We're talking dispositions. You're going to sell. Right. Who buys a multifamily property? Somebody who is an investor. What does every investor want? They want a discount. You're going to sell it for a loss, right? And because think about it, what investor dispositions? Investors buy multifamily stuff. You have far more disposition strategies for a single family house. You can sell it on land contract, sell to an FHA buyer. You can sell it and carry the paper, right? There's far more and better dispositions strategies for single family. Not to mention, when you're building a portfolio, and Tim and Rod, you guys have built it from the ground. When you're building a portfolio, sometimes you get a little cash tight. You got to figure out things and make things happen. When you're building a portfolio, you can pair off properties, sell one or two of them. You're building a single family portfolio, sell one or two of them. Boom, boom, boom. What are you going to do? A condo conversion with a multifamily property? What are you going to try to sell one of the units? It's very difficult to raise capital when you're building these portfolios, and it's far easier when you have a single family portfolio, simply because there are so many disposition strategies, unlike multifamily.
We're gonna get into that when we talk about construction and when we talk about management. But that's a huge point, right? Local government. If you own 100 units in one building, or you own 100 houses, and you want to raise some capital, you can go sell 2, 3, 5 houses and put $25, $50, $100, $300,000 in your pocket. Now you have the capital to do what you want to do over on this side. You can't par off and sell, building 6, floor 2, units 5 and 9. Like you can't sell those off to go raise capital. And so to Dave's point, one of the things that I like about single family is the diversification, the ability to be spread out, and the ability to sell off assets for cash and capital, because governments change regulations. You need more capital. Financing changes. You need more capital. Construction costs go up. You need more capital. And we'll get to a huge construction exposure that people had back in 2005 that I watched happen. It took a lot of people out, but we'll talk about that in the next segment.
And government exposure. You mentioned the government. The government's far more likely to go after the big evil multifamily guys.
All right, Dave, I got to catch you up, my man.
All right. Tim, can I please?
Rod, you guys got 2 minutes for your rebuttal.
Yeah. All right. So I'm going back to where Rob started around not having credibility. Guys, I've got students that have maybe owned one house that now have 1,000 doors, or no houses that might now have 1,000 doors. Why? Because multifamily is a team sport. Single family is a team of one. Multifamily, you put a group together, and that's how you go after these assets. Okay, so you can find the experience on the team. You can find the liquidity and net worth you need for the loans on the team. You can raise the at-risk capital, it's called, the earnest money and the down payment and I'm sorry, the earnest money, the third-party reports and the things, the due diligence costs, all of that can be sliced into the team, and it's a team sport. So everybody starts that way in this business. You don't have to have experience. You can even, frankly, do it with no experience. You get a Freddie Mac loan, you just hire a good third-party property manager. You can do it with little or no experience, but you can align with a sponsor or put a team together and divide and conquer. That's how this business is done. Now, as it relates to bailing, your comment around my comment around bailing. When we're watching a market, if we see it start to turn, it's not when it's down at the bottom where we can't sell or have any exit strategies. We're watching it on a literally monthly basis to see what's happening there. And if something happens to turn, now most markets don't turn, but if they do, then that's when we bail. We're in this for legacy. As far as cash tight, these assets cash flow extremely well. And when you purchase them, you raise operating capital. Like we just purchased an asset in Cincinnati, and we have $1 million sitting in the bank that we raised just in case. Okay, so you raise that capital, and you can also raise capital after you close. Okay, you can absolutely raise capital after you close, but we raised it in advance. We have big operating reserves, because of literally what happened to me in 2008. Hit me once, shame on you. Hit me twice, then it's my own damn fault. So, we over-raise on capital, and we still have incredible returns. That Cincinnati asset, we can break even at 65% occupied, economically occupied. So, there are deals out there, and I think the more deals are coming. I think there's some serious distress coming. All right, fair enough. I'll be nice. I'll stop talking.
It would be nice to hear from Tim Bratz once in a while. This is
I have a feeling Tim's got some stuff.
He's saving up. He'll hit you between the eyes here any minute. He's gonna.
You guys are great sports. We're gonna move on to round 3 here. Again, guys, I haven't even announced what the bonus round is gonna be, but we're moving on to round 3, financing. So let's start with the single family guys, either Dave or Rob. Why is single family a superior asset class when it comes to financing?
Well, here's the thing. And, with all due respect, Mr. Khalif, you didn't even realize these financing programs are available to single family as well. You're, talking about the non-recourse debt and how great it is. Well, I've done numerous of these. Call CoreVest, everybody. I'll give them a free plug. Call Lima One. They're back. They're doing 75%. In fact, the LTV is probably better. You can do non-recourse financing on single family homes all day. Not to mention, when it comes to financing and raising capital, that was a huge point that you made there, Rod. And hey, everybody could raise capital against an asset. The thing is, when you're raising against a single family house, it's far safer for the investor. When you're syndicating money, what happens if and when? And by the way, shit has already started to hit the fan. I mean, not to curse, but you talk about you wait for the market to change. Well, the market's already changed. I shared that in the very beginning. Multifamily starts are down 42%. The big money is pulling out. The big money already knows what's going on. And when you're raising capital for a multifamily syndication, it's far, you don't have a note, you don't have a mortgage, you're part of a group, right? Like you said, a group, it's far more difficult for your private lenders to get their money out when what has already started, things start to pull back. Nobody wants to be in a multifamily house. Rob, what do you got?
Well, I've raised a lot of capital. I mean, I get how it works. I get how you guys have done it. I put big funds together. The easiest money I ever raised was $10 million from one group. And it's far more difficult to raise $25,000 from John and Sally than it is $10 million from one group that gets it. I can't even tell you how much easier. Here's my approach to single family financing. I don't go out and finance properties other than with private money. Private money funds my acquisitions. Private money funds my construction. Private money funds my operations through lease up. And then I take that private money, and now I've borrowed my private money such that they have a positive cash flow. The asset has a positive cash flow, and I can turn that around and I can bundle 5, 7, 10, 20, 25, 50, 100 of those together with a CoreVest, a Lima One, into non-recourse debt, not personally guaranteed, non-recourse debt against the asset. I can still piece off and sell off those assets. And I can do that again and again and again. And then I free up that private capital, which is in a first lien position, right? When you raise capital under a 506, I assume maybe you guys are raising under a Reg D 506. The first 3 pages of that Reg D is bold, all caps, and it says all of the ways that the person is going to lose money. And then it gets into the opportunity and the upside. And so most investors skip the first 3 pages. They don't want to read the all cap stuff. Then they get into the stuff where the opportunity is. What in a single family strategy, what I do is I go raise one house, one investor, first lien, first note, deed of trust, and then I package those together and refinance them out. And so, so Dave, that's exactly the strategy that we use. Yeah, can you do it other ways? Absolutely.
I got a question, Swanson, I got a question for you. What happened on August 13th, 2007?
August 13th, 2007 is when basically Wall Street stopped buying the debt. It was the day I woke up, I called my buddy, or my buddy called me and said, hey, this big commercial loan operation that I had with 50 people in our office, it's over. Literally, Wall Street stopped buying their debt. So their $500,000 warehouse line had basically 3 days to operate, and they were out of money. And so literally overnight, financing changed, and the whole game went different.
The LTV, by the way, I would argue is better when you're bundling single family houses together for this non-recourse debt. It's better than a multifamily property. Everything is better from beginning to end when it comes to financing. Beginning to end, from the private money raised, you can raise money against the single family house. It's actually safer for the private money lender through the construction. We're going to get to the construction and whatnot, all the way through getting it leased up and then getting it refinanced out. Our investors are far safer. Our investors, you guys do it right. You guys do a great job. Go ahead.
Dave, investors don't understand. The investors that come in oftentimes on these deals, they don't understand the position they're in. They don't understand that they're in an equity position behind debt because they didn't read the first 3 pages of the 506, right? So they don't really understand the risk that they're taking on.
Excited. They want to be. It's an exciting thing to be part of a group or a multifamily. It's just extremely risky.
I'm taking this. Rod, I got to take this.
Oh, please.
Go for it, Tim.
My heart.
All right. I love you guys. I respect you guys. And I think we can agree because you guys had mentioned, hey, you could be a newbie and not know what you're doing investing in a multifamily. You can get your ass handed to you. Same thing can happen in single family. Like there was this clown at the Real Estate Investors Association up here in Cleveland that went and took a single family house. It was like, hey, Rob, I'm going to give you a first lien mortgage. Dave, I'm going to give you a first lien mortgage. Alex, he gave the same first lien mortgage to 3 different people and never filed it. And guess what? Everybody lost their money. Yeah. So the same scam can happen, or people can get scammed easier, I think, in single family than they can in multifamily. When I go and get a multifamily loan and a bank's going to give me $8 million for a $10 million acquisition, do you think they're just going to believe me that that's worth what I say it is? No, the bank has their own representatives that go out and walk units, that review all the financials, that look at the physical due diligence on the properties. They cross every T, they dot every I, because they're putting $8 million in play on this property and make sure that their investment is super safe. There's not just my eyes, it's not just Rob's eyes, it's not just Dave's eyes that are putting their eyes on the property. And now I'm be subject to how well Dave Payerchin does his due diligence or how well Rob Swanson does his due diligence. No, this is a third-party bank institution that is hiring professionals to go in and rip this place apart and find anything, turn over every single rock to make sure that there's nothing hiding and they cannot get scammed somehow out of their
Let me add something. And their focus is on the asset's ability to pay back the debt, not the team. And that's why it's a team sport in this business. I got to say, I got tired listening to you guys, tired in the way that thinking about the work involved, one house at a time, go buy a house, go finance it, put a big package of houses together. Cause I've been there. Again, I've owned 2,000 of them. And so, I had 800 here in Denver. I'm from Denver, here in Florida when it all crashed. And so, it's one house at a time. And by the way, back to your August comment, that was commercial mortgage-backed securities that crashed. Okay. Yep. And Fannie Mae and Freddie Mac didn't, they didn't stop lending, but all CMBS went out the toilet. It was, at least if you could fog a mirror back then, you could buy a house. And this was, Wall Street that created that catastrophe. But, you say starts are down. I got to tell you, the multifamily business is freaking booming. Okay, vacancies are at an all-time low. Rents are the rents are being collected. I mean, it's going well. Now, again, back to financing for a minute, Tim. If you had something, I've got some stuff to talk about financing. But I cut you off there for a second. So if you got more,
I mean, the other point that I would make is, if you go and try to, like, here's the thing: in single family, you have to either use 100% of private money, or you have to use a bank loan along with your own money. Mm-hmm. In multifamily, I go and I happen to use my own credit, my own balance sheet to sponsor these loans, but I wouldn't have to. To Rod's point, like, we can absolutely bring in a co-sponsor, which is standard operating procedure in most multifamily syndications.
And you can raise the money for the at-risk capital as well. You don't have to bring that money in
exactly.
even.
Like the banks expect the money to come from somebody else. I have $330 million of real estate, a portfolio where I'm the managing member of over 95% of that. Okay.
And how fast did you get that?
In 5 years.
There you go.
Now, I've been in real estate longer than that, obviously,
right,
but I had to liquidate everything 5 years ago with a bad partnership.
That portfolio is in the last 5 years.
Yes. And to my point, $330 million of property. I'm all into it for around 215. Okay. So we have a lot of equity built up. I've only personally invested $125,000 of my own money into my portfolio. That is how easy it is to raise money for multifamily.
There's
real estate.
Tons of money looking for a home, and not to say they're not looking for single family. They may very well be, but I'm telling you, people are clamoring for multifamily and to get involved because of the returns and the safety and the low risk and the and all of that. And again, it's a team sport, so you've got to satisfy 3 requirements with multifamily financing: experience, liquidity, and net worth. The experience you can actually get with a management company, but the liquidity and net worth, you find one high net worth doctor, and you can satisfy those requirements. And so it absolutely is a team sport. And every property you buy enhances your ability to finance. Where I'm not sure that's the case in single family. Certainly not with banks. They start to see too heavy of a load, they get nervous. That's not the case in our world. So
good point. And one last thing. I know we got like 10 more seconds. I have 165 million in bank loans. If you pull my credit, not one thing's going to show up.
Yep.
All right. We have the same loans. I have the same loans. I do the same thing.
All my single family loans used to show up on my credit.
Agree or disagree. A private lender is more at risk in a syndication than a first position.
Disagree. 100% disagree.
I mean, it's common knowledge here. I mean,
100% disagree.
I do too. I think it's much more risky.
Dave, you guys got 2 minutes for your
rebuttal. If you invest with the wrong operator, you're at risk in single family. If you invest with the wrong operator, you're at risk in multifamily. It depends on the deal, it depends on the borrower, and those 2 things are going to predicate how risky that investment is. But
our first position note mortgage is far safer than any syndication. There's a you talk about clowns. Talk about Grant Cardone. He's going out of business. I mean, he's buying too much.
Not going out of business.
People are clamoring for multifamily. People are paying too much, and that's the first financing to go away. Is the commercial, like we were talking about. But a private lender specifically is far safer. It's far safer than let's pull our money together because it's exciting to get involved in multifamily. Somebody, a bad operator, not you guys, is going to buy a bad deal. They're going to have a hell of a time getting their money out of it. So they just ride
the safety net in multifamily is that they're not going to get financed if it's a bad deal. So that's a big safety net. Okay, it's not like they're using their own money.
The first position mortgage, the bank has all the control. They have all the protection. These people who are throwing their money around with Grant Cardone and the rest of the clowns out there, not you guys who do a good job, but they're going to lose their money and they're never going to be able to get their money out of this.
Rob, where do you land on this, man?
Well, I'm of the mindset that most investors are in a riskier position, in an equity position behind debt than they know. And so I do believe that an investor in a first lien position on a single family house, 1 loan, 1 house, one asset, is in a safer, more secure frontline position than in a pooled position where they don't have any control and can't gain control in an equity position behind debt. It's the debt that adds the risk. The debt on the front end of the acquisition and construction money, the refinance for the long-term money, guys, it's the debt that adds the risk.
It's all about the operator. Bottom line, I don't disagree. It's a safe position to be in a first mortgage position. No, I don't disagree with that at all. And it's one freaking house at a time. So that's my rebuttal to that. So
you guys got 2 minutes.
I bought and I flipped apartment buildings before with one investor to a single mortgage on an apartment building. So if you want to get into apartment buildings, you can do the same thing and give them a first lien position and a promissory note, and just don't get bank financing. Or you can pull a couple of investors together and give them all
joint venture a deal.
There's a lot of ways to structure it.
Yeah, you can.
And the other thing that I would say is, when you say that they have no way of taking over control or ownership, in all of my operating agreements, if Tim, the managing member, lies, cheats, steals, does anything grossly negligent or fraudulent, my investors take over operations and my ownership of the deal.
I agree with that. I agree. Certainly. What I'm talking about is the individual investor, right? Probably, John Smith probably isn't going to go in and take over Tim's operating position because John Smith is a part of the group. They're going to designate somebody probably that has some experience to step into that role. So I get that. That's the bottom line to me is we're talking about financing, and we've landed on a topic of the private investors that are coming into these deals, and debt in front of an equity raise is a riskier position than on a single family first lien position.
Based on the operator, I agree, but I can tell you back in 08 and 09, thousands and thousands of private lenders got freaking crushed in single family. Okay. Thousands of them across.
That's just based on the operator. It's based on the paperwork. A mortgage or deed of trust in first position is far more, than a Reg 506.
I mean, we're talking about things that, again, you can get burned in single family. You can get burned in multifamily. It depends on the deal. If I go and buy an apartment building and I'm at 50 cents on the dollar. Hold on, Pardo. I got to finish this thought. If I'm at 50 cents on the dollar and the bank's going to give me 40 of those cents and I go get the other 10 cents from an investor and I'm all into that deal for 50 cents on the dollar, the deal's still at a 50% LTV, right? Versus you can go buy a single family house and you get all one individual investor to give you 100% of the money and you're paying 90% on a deal that, $90,000 for a deal that's worth $100,000, you're at 90% LTV. So you can say both ways, right? It just depends on the deal and it depends on the operator.
All right, let's wrap up this round here. Let's move on. I gave the multifamily guys some grace, so I'll give you guys a little bit of grace on the next round here with some extra time. So round 4, gentlemen, we're going to move on to management. All right. The last 2 rounds, guys, management.
We can skip this one if you want, because this is a hands down. I mean, this is a lay down. Honestly, this is not fair to these guys to get into this one. Seriously.
Well, you guys are going to lead us off here.
They might kick our ass in construction, but they aren't going to beat us in management. No way.
We shall see. What do you guys think? Comment below and let us know what you think here. But Rod, Tim, when it comes to management, why is multifamily the superior asset class?
Can I start, buddy? Do you mind if I start? Thanks.
Absolutely.
Here's why. This is like painful for me to talk about because I got this lesson in 08 and 9. Okay. This is why I crashed and burned. I will tell you, I had houses over a pretty wide geographic area along the Gulf Coast of Florida here. And, even as far north as 2 hours away, far south is 2 hours away, and everywhere in between. And if I had to send a maintenance guy to one of my apartment complexes, everything's the same. All the appliances are the same. The locks are the same. The plumbing parts are the same. The HVAC is the same. So we could stockpile parts. I could send them. They're in and out in an hour. Boom, done. If I had to send them to one of my houses, first of all, they got to get there. Who knows? Might take an hour each way. Then they've got to see what's wrong. Every house is different. So, you can't have them cookie cutter. And so they'd have to go see what was wrong. Then they'd have to go find a Home Depot or a Lowe's where we have an account. They go back and bring parts. And I don't know if you've ever fixed anything, but maybe it's just me, but I typically have to go to Home Depot more than once. And, what took an hour at one of my apartments took all day at one of my 800 houses. And so, that was probably the biggest hit on my cash flow. And so that's not the case with an apartment complex. You can hire on-site staff with an apartment complex to handle all the day-to-day management for the leasing and the tenant relations, maintenance for the maintenance. Logistically, so much easier to manage than houses scattered around. I mean, it's really common sense. Okay. I've owned a property management company for my single family in Denver and Memphis, here in Florida. And it's much, much harder for single family than it is for I mean, just common sense to have everything in the same location for leasing, for tenant relations, for notices, for maintenance, for every component of this, for inspections. It's kind of a no-brainer. Tim?
Yeah, I think because of the scalability that Rod's talking about, the management's it's less expensive. It's way easier to manage. And because it's easier to manage, because you're not driving all over the place and sending people all over the place, it's less expensive. So you can make more money. So if you have 100 houses at $1,000 a month, or you have a 100-unit apartment building with $1,000 a month, and you're paying 10%, or let's say 8%, even if you get a good deal on your management fees,
on the houses,
on single family houses, versus I pay 3% on my management fees. That's just the fee. Now on these houses, you're also paying a 1-month leasing fee every time that house turns over, and whatever the overhead is built into all that stuff. Now on multifamily, I have payroll, right? There's people on payroll, managers, maybe leasing agents, but on average, when you average out the amount of turnover and what it costs me to lease a unit with having on-site management staff, it's around a quarter of a month of rent.
And maintenance.
And maintenance, yeah, it's around a quarter of a month of a leasing fee versus a full month of a leasing fee. So when you balance out all the expenses, it's easier to make more money and more cash flow in apartment buildings than it is in single family.
Now you have to asset manage, of course. You've got to manage the management company, as it were. And so, we've got typically an hour-long Zoom call with each management company for each asset, that, the third-party side of things. So there is that. You have to manage them. But I mean, again, that's an hour a week, unless there's unless you're doing a major reposition and renovating all the units or something of that nature. But management companies will even handle that. We've got one that's doing a bang up job on an asset right now. So, it's just, again, it's common sense. If everything's in one place, that it's easier to manage.
And the sophistication, Rod, you hit on this earlier, is like my management company manages 22,000 doors around the country, the one that I use.
Yeah.
So they understand not only how to manage, but the business elements of how to scale a business and be accountable and all these other things, right? Versus my property managers in Cleveland on the residential stuff before I started my own company, it was disastrous. Yeah. Nobody could manage. It was a realtor with their license who's running around to houses, giving me a report in an Excel spreadsheet that they type in their own numbers. They're not sophisticated in any capacity. And it was a big issue.
And that's really common. That's really common. It's really common in that space. I had a property management company embezzle $100,000 from me in Memphis. It's same units were empty and they were occupied and they were collecting cash. It's the wild, wild west, because anybody that owns a couple of rentals thinks, start managing and have some income, and they haven't got a clue what they're doing. And these third-party property managements, like managers like Tim describes, that have tens of thousands of units, they've got a whole marketing division, and they've got it down to a science. They know how to turn over fast.
They'll go and move and live in a unit for 30 days, 60 days, 90 days,
whatever it takes.
There's enough scale there because there's so many units in one location. So again, it's easier. And the other thing is, from a risk standpoint, like, we're giving our financiers quarterly statements and showing them like quarterly financial statements that's being checked up on from our financiers every 90 days. Do you ever get that on the single family side? No, because it's up to the operator on do they want to give updates or not.
All right, gentlemen. Dave, Rob, go ahead, guys.
We can give them a little extra time on this one. They're going to need it.
No, I mean, go ahead, Swanson. Start us off.
So why? Let me just set the stage again. Why is single family a superior asset class when it comes to management?
So we knew that you guys are going to talk about scale. Every argument has been scale. We get it. Multifamily scales well. I'll just take you back to my story back in 2005. Right. Well, I'm not arguing with you. I'm saying multifamily scales well. Back in 2005, I owned 40 some houses roughly. And I said, you know what? The market has gone up from the time that I bought them. It has gone up and appreciated significantly. I could kind of feel like, and I owned them all in Denver. And so I felt like things were peaking out. They were getting to a top. Affordability didn't make sense. So in 2006 and early 2007, I sold my entire residential portfolio. I looked like a genius. And
you had it now, huh?
Oh man, no doubt.
I had 500 houses in Denver. I would be netting $500,000 a month if I'd have kept them.
Yeah. No doubt. It's painful to look back, but here's why. Here's one of the reasons why I sold them. Because when I got into single family, I wasn't a good landlord, and I hadn't figured out how to build the systems of being a landlord. And today we have a standards guide. Everything that we do with our residential portfolio, the same locks, the same paint, the same trim, the same windows, the same roof tiles, the same color schemes. Everything we do is standardized. And so when we send out, if it's a brand new handyman or it's a brand new management company, we send them our standards guide and we say, hey, here's what you do. And so just like you guys have systematized the standards in an apartment building, we've done the same thing in residential. It just took thinking about it to do it. Dave.
I want everybody just to visualize this, okay? It's a dreary apartment building, right? They're all a little scary as far as my eyes. I get nervous at these apartment buildings, guys. But you meet your neighbor, start a little hallway talk, stay 6 feet away. Maybe you got your max. You don't know if your neighbor's got COVID, and then you start chit chatting about the lease. It's like, well, how much are you paying in rent? You're paying 60 more than I am. You know what? It's so it's not fair. Next thing you know is the tenants, they all start to unionize against the apartment owners, right? And then when it comes to these tenants, good luck raising the rent on anybody. They all communicate with one another. When it comes to a single family portfolio, they don't know what you own. You can play with the lease in such a way and set your lease up in such a way where you have no management. We don't even get phone calls. We do so many different, seller carrybacks, create cash flow streams with, rent to own and stuff like that. When somebody calls us for maintenance and management, we tell them to call the Home Depot. Right? Because that's how we set up our lease. You can't do that with an apartment building. And if you tried it with one person, they're going to go tell all their neighbors. Everybody's going to conspire against you. And then guess what? Let's pretend, hey, we don't know who's going to win this next election. It could be, we could turn into a crazy country, right? But if the government was to get involved with things like rent controls, right? We're talking management, right? We're talking rent collection. The government is far more interested in going after apartment owners, just like they started in New York City. They were going after the big building owners, guys, because they don't want to go after the mom and pop landlord. So you can structure a single family portfolio in such a way that you have no management whatsoever, because not to mention our people aren't turning over like your guys are. They're out of there. They can't wait to get out of the apartments, right? They're saving up for one of our houses, and then they're going to stay there forever. They fill the garage with all their stuff. It's great. They want the storage, but the government, if government was to get involved with rent controls and stuff like that, who do you think they're going to go after? The big handful of apartment owners or the thousands upon thousands of mom and pop landlords out there, right? Who are all voters. They're going after the apartment owners. The tenants it's harder to really raise the rents on the tenants. And not to mention, we're dealing with residents who don't even want to be there in the first place. They can't wait to get out. Right? So management is you guys pay 4%, 3%, we pay 0%, and we get no phone calls. You can do that with a single family portfolio. You cannot do that with an apartment building. Rob, bring us home. Swanson.
Yeah, I mean, like I said, the way I have built my portfolio today to standardize, I standardize upfront. When we buy an asset, we rehab an asset to our standards. That's how we manage the asset. That asset sets us up so that we can exit it through a sale. We can sell it to a homeowner. I can sell it to an investor. I could sell it to my tenant. I could sell it to anybody, because we've standardized things in such a way that not only is that house attractive, not just for a tenant, but it's also attractive for an owner occupant. So I know I've got 30 seconds left, but Alex, I'll bounce it to you.
Okay, beautiful, guys. So, Tim, Rod, you got 2 minutes on. I feel like Rod is chomping at the bit here.
Oh,
so
I got all kinds of notes here. I love the painting you painted for us there, Dave. tenant unions. That's a good one. Listen, yes, if this becomes a blue country, rent control could be an issue, but I think it'll be an issue for everybody, landlords, not of every kind. But, listen, as it relates to standardizing homes, yeah, we tried to do that as well. Of course, same appliances, same paint, all that stuff. But you're not going to redo the HVAC. You're not going to redo the hot water heaters. You may not redo the locks. There's some plumbing fixtures. If you're not changing out the plumbing, they're all different. And so invariably, there are going to be differences. The roofs could be different. You could have flat roofs with pitched roofs and everything else. So there's still going to be lots of differences. As it relates to harder to raise rents, buddy, that's what a third-party property management does. We get a rent survey every freaking 3 months so that we can bounce rents as units are turning. And so you want to add to this, Tim?
Yeah, I think I will say the way that Rob Swanson invests in single-family real estate is the only way that I would invest in real estate if I ever got into single-family again.
Agreed.
I love what you're doing, Rob. I think you have a great
agreed
business strategy of how you do what you do. So I'm not going to take anything away from that. As far as the single family, Payerchin says that he pays 0% management fee with his properties. That's because you're selling them. Well, guess what, dude? Now you have a job. Now you got to go and buy more again. That's not building wealth. If you wanted to own these things and hold them long term and build real wealth instead of just transactional income, you're going to pay a management fee, and you're going to pay 2 to 3 times more than what I pay my management fees with.
I have one thing to add on the model that he does, where they don't pay everybody pays their own maintenance. I can tell you, they get a roof leak, they get a plumbing leak, invariably that stuff continues until you get the property back, and the damage is much worse than it would have been when you started. I've seen that time and time again because I tried that model myself. What I changed it to was you pay the first 100 or 200, we'll pay anything beyond that so the big stuff doesn't get really bad. That's the model we changed to.
A lease option is not a sale, and we still manage our portfolio just as if just inspecting the property, care for it as if it's our own. But no, we're not selling them. Sometimes we do if we own something free and clear.
A lease option is a sale, dude. You got a lease with an option to buy it. If they execute on that option, then you're selling the building.
And Rob knows, and Tim, you know this as well. Very few people are actually going to perform on the sale, but there's still that pride of ownership,
Well, sometimes.
The point I was making is just there's far greater disposition strategies. It really goes back to dispositions and the pride of ownership of the resident that's living there. I'm not going to discredit anyone who lives in an apartment because I grew up in apartments and I've lived in apartments a long time. I'm not going to say anything bad about anyone who lives in an apartment, but it really comes down to, if somebody's going to take care of a property, it's going to be a house, right? That pride of ownership is a very real thing. We've been doing this for years, just like you guys have done this stuff as well. And we have very, very few phone calls simply because the people want to be there. They live there. And we do still inspect our properties. Swanson, we only got a minute here.
Well, I think this is like debate both sides, right? Or is this one side or the other at this point? Alex, help me out here.
Swanson,
look, we're talking about management. You guys have
so we're debating both sides, and actually, we build a community in our apartment complexes. I mean, I can't say
so I think we've got 1 minute left. Is that right, Alex?
Yep, you got, and it's you, Rob.
Okay, all right. Forgive me. I thought it was back and forth here.
Nope,
when it comes to all the things you guys are talking about, at the end of the day, get your systems done right. If you're a single family home investor, build your systems. Stop. Learn, get knowledge, build your systems, because you don't have to live in the single family world with a bunch of unknowns and a bunch of varying costs and you can build your systems. And if you run this like a business, okay, owning multifamily is a business, owning single family is a business. If you run this like a business, build your systems, and management does not have to become an issue. I manage, Rod said it, I manage my managers. Every week, I take a look at a weekly report. Every month, I dig in deeper. We make any adjustments we need to do. I manage my managers. And guess what Rob never gets? Rob never gets a phone call from a tenant. Tenants don't know Rob exists. Rob is so far outside of the equation that it's not even funny, because I've put systems in place. I operate those systems. I manage those systems. and I manage the managers.
And we do the same. And I just want to give a shout out to our team, because I think Rod said it is a team sport. And I think we got about 11 people on our team who are watching this. So shout out.
And just a quick rebuttal. So you brought up the point, where are you, for the people that are watching? I mean, guys, you guys have created these massive, incredible infrastructures. I mean, hats off to you. I mean, every business is nothing but people and systems. You've got a team, you've got the systems that you've created. But that said, for someone that's new getting into this, if they bring on a third-party property management company to hire to handle a property, they've already got the systems. So for someone brand new, it's an easier way to start than to go into single family and build over years these big teams and these systems to do single family, where in the multifamily space, literally you can hit the ground running. You literally could make your first deal, 100-unit apartment complex, and hire a third-party property management company. And I mean, that's an anomaly. People don't normally start that place, but the point is you could, because you don't have to set up the systems.
Rob, Dave, you guys got a quick 30-second rebuttal to what Roger said?
Yeah, well, that presumes that person just getting into the business has the knowledge on what assets to buy, has the credibility to raise the capital, and has the ability to put it all together and make it work. And yep, you're right. It's a team. It's a team sport. I get that.
They align with a team.
That's right. But that presumes that person just getting started. And so what I'm telling people is, hey, if you're in that place where you're getting up and you're walking to a job every day, ask yourself, can I in the next 30 days buy a house that produces a $300 a month cash flow? Can I stack that over the next 90 days and get $1,000? And then can I repeat that process time and time and time again and get where I want to be financially?
Beautiful. Guys, we're going to move on to round 5 here. Really appreciate you guys kind of abiding with the time. I wanted to give that one a little extra rope because I think this is super, super helpful for everybody watching and listening. At the end of the day, we're here to have fun, but that's the goal, right? To help people, whether it's single, multi, you guys can't go wrong. You just got to choose what's right for you, right? So guys, round 5, and then we got that bonus round. Round 5, when it comes to construction, I know Rod has not been looking forward to this one. So when it comes to construction,
listen, there are people killing it in multifamily construction. It's just not something I've done, but I can speak to it to some degree.
So we're actually going to start with single family first. You guys are going to start the bonus round. So Rob and Dave, when it comes to construction, why single family the superior asset class?
Sure. So I'll start this one out. And, everything we're talking about, using the same paint, using the same cabinets and whatnot, it's very doable when you do have the right systems. I'll just piggyback on the last conversation, and we do it. And a lot of single family operators do the same exact thing. So you could do that with either asset class. And the cost of construction is something that we want to talk about. And I know Rob or Swanson, why don't you touch on cost of construction, post-hurricane construction? There's a lot to be said. When your rehab budget on a multifamily property is $2 million, there's far more risk than an individual single-family house. Swanson.
Yeah, well, so this happened back in 2005. I don't know if you guys were in real estate or investing or what you were doing back in 2005. But I think, Rod, you probably had a bunch of single-family houses in Denver. Memphis.
Oh yeah, I had 500. I wish I'd never sold because they'd be free and clear. I'd be doing this from the back of my yacht right now.
That's right. So Katrina hit. I don't remember what month it was in 2005. Katrina hit, and the cost of construction skyrocketed. Drywall, 2x4s, nails, cement, you name it. If it was construction materials, it skyrocketed 50, 60, 70%, depending on what it was, over the following 3 to 6 months. And so if I'm an apartment guy and I'm thinking about, again, if I'm an investor looking to invest in apartments and I'm thinking about the risk exposure, nobody saw Katrina coming. And could Katrina come again? It absolutely could. So if I've got a $2 million budget to renovate this apartment complex and all of a sudden my costs go up 70, 75% on the construction side because materials are through the roof, and now all of the labor is down rebuilding the Gulf Coast. My labor goes through the roof. My materials go through the roof. I take my budget from $2 million to $3.5 million on a single asset. I'm kind of SOL. I'm kind of screwed right there. If I've got a $20,000 rehab on a single family house and I have the same increase in percentage, I turn that $20,000 rehab budget into a $35,000 rehab budget. It's painful. It really sucks. I remember it. I lived it. In 2005, I was buying and selling, investing, and holding real estate. And this is exactly what happened. But I can probably get through a $15,000 increase easier than I can get through $1.5 million increase on a single asset.
If I may, I already know that, Mr. Bratz, because he's been taking jabs at me and I saw your video, he's going to say the construction, the contractor, the caliber of the contractor will be far more sophisticated on a commercial building than a single family. I think Tim called a single family contractor Billy Bob with a smoking truck or something along those lines. Well, and just so you know, all the listeners out there, if you're a contractor, that was Tim that said that. That is not me. I'm not here. Single family. But there's something to be said about that. Sure. Maybe, why is the single, or why was a commercial contractor more sophisticated? Because they charge more. And what's going to happen to this contractor after it's already fixed up? Are they the same person who's going to be maintaining your property? No, they're gone. They cashed your check. You probably paid way too much, found them in the yellow pages. I don't know where you find these giant commercial contractors, right? But who's going to be maintaining the property? Because that's part of construction as well. And I would argue the caliber of the maintenance person on a multifamily is equal to, or maybe a little bit less than the caliber of somebody who's maintaining a portfolio of single family homes.
You know what? I actually don't disagree with what you just said. Let me tell you why. Because
hey, you get your 2-minute rebuttal.
I'm going to help you. If you want me to help you, I'll help you. I'll help you. If not, it's fine. I'll shut up.
Go ahead, Swan.
Yeah. So here's what I think. When Bob rolls up in his white wrapped truck, and he's got his graphics and his logo all over the side, and he's got his khaki pants, and he's got his clipboard, I know I'm paying too much. Bob's not my guy, right? And a lot of people then say, okay, well then you're left with, John, who's going to come and go, and he's not going to be professional. So I look at, I'm trying to drive margin in my contractors, but I'm trying to build relationship, right? I want to take a guy, and I'm going to give you guys an example. I got 30 seconds. Back in 2008, amidst the financial crash, when Wall Street stopped buying the debt, everybody was filing bankruptcy, Bear Stearns, Lehman Brothers, they were all going under. I put a $10 million fund together, and I found a guy that drove a jalopy car, a piece of crap car that couldn't run construction crews because he was all over the place, but he was really talented. I brought him in. I showed him some things. I helped him systematize. He brought his crews together. We gave him some scale to his operation. I said, I'm going to tell you my budget, you meet my budget, and I'm never going to argue with you on price as long as you meet my budget. And you know what we did? We took him from struggling and getting by to this day. He does a lot of investors' work in the Denver area, and he's referred to by all of the hard money lenders because I found this guy. We helped him build a system in a business.
Well, it's awesome that you had the time to do that and the wherewithal, and it's a nice thing that you did. But I'm going to tell you that to compare a single family company that does remodel on a single family to a commercial company, yeah, you may pay less on the single family, but you're not going to have them come back on the commercial side, okay, like you will with the single family. You're going to have on-site people. But in deference to your comment around maintenance guys that work on single family houses versus apartments, I would absolutely agree with you. They are more skilled because they see every possible scenario. You don't get that if everything's the same in an apartment complex. When I sent my guy that works here in my compound to one of our assets in Louisiana because he's done everything. And most apartment maintenance guys are good with what they're dealing with at that apartment complex, but they don't encounter the diversity that someone that does single family does. But that comes back to my thing that every house is different, so they become really good at every scenario. Tim, if you dog them,
I got a bunch of stuff.
All right, please.
All right, we all know that in construction, there's 3 parts of construction. You can have quality, you can have it done on time, or you can have it at the price point. You get to pick 2 of those things. You don't get all 3 of them, right? I would far more outweigh quality and getting it done on time than price, okay? You said, Rob, that you're trying to drive margin. The reason you're trying to drive margin is because you need to, right? Because you're in a bunch of single family houses and you don't have scalability. You don't have the margin that we have. the other thing that you mentioned is like, oh, my budget goes from 2 million to 3.5 million versus like that's apples and oranges. Like if we were comparing 100 units and your budget was $2 million and it went up to 150 or 1.5 million,
2.2, whatever.
Yeah, it'd be the same thing if you had 100 houses that you were doing renovations on. So if you're comparing apples to apples, it's kind of like a moot point. I will say that we already drive margin. I'm closing on land next week to build 82 townhouses that are separately parceled that I could sell off one at a time if I wanted to refute your argument from earlier. And I'm building those 1,100 square feet a piece for a total of $6.8 million. That's $75 a square foot with today's construction costs. Post-COVID, with supply chain deficits, $75 a foot to build nice townhouses.
Which sounds like a job.
Well, not once they're done. It's a one-time job. Then once they're done, you got 82 units to rent and probably some significant cash flow.
To rent, we'll rent for $1,100 a month all day. And I can sell one off at a time if I want. I can finance it as commercial real estate if I want. I'm building it in pads. So I'll build 3 to 5 on a pad at a time, and they'll all start coming online. And because all the stuff's going to be on site, all the supplies, all the vendors, all the materials, all going to be on site, we're going to slam out 82 units in less than 6 months.
You sound like a single family home investor that just figured out scale.
You can do the same thing.
Every national
That's what you're talking about.
When we're building single family homes. This
You're
is not
talking
an argument at all. It's the
right.
same thing. You go when they're selling single family new construction. What do? You go look at 3 models. It's number 1, number 2, or number 3. It's like, right. I understand what you're building is.
I don't build 4 walls for every single one of them. They have 3 walls on each one, or 2
it's
walls.
The same thing. If we're talking new construction,
there's way more scale. No, there's not. It's all in one location.
You can absolutely, you're talking new construction, you can absolutely build, single family homes. In fact, the demand, you're probably going to get more of a premium, whether you rent or sell, because there's more of a demand. But you can do the same thing, drop off all the materials, everything.
Honestly, Dave,
you guys got a minute left.
We can just let Tim keep talking because he's making our point. Single family homes. Go ahead.
100%.
I am building multifamily, and I'm parceling it to your point of saying, oh, we can sell these off individually, and I can make my money back, and I can
keep it as one complex, or you keep it as one complex.
I can do the exact same thing,
right.
Or I can keep it as one
complex. Listen, there's a real opportunity, guys.
There's way more opportunity in this.
Let me tell you the opportunity. Just as a gift here, there's a real opportunity to find land that's entitled property for density, meaning you can have multiple units on it, or you can entitle it yourself. Find an owner that's owned this property for a long time, bring them in on the deal to develop some apartments. It doesn't have to be 100. It could be 20. It could be 10, whatever. Bring them in on the deal. And you can very often start one of these things with little or none of your own money because they're putting their land in for the equity. So that's an incredible model. And right now you can absolutely build to rent. Now, it hasn't been the case all the time up to this point, but right now that absolutely exists. And so that's an incredible opportunity.
All the big money, Wall Street money, the asset class is SFR. They're building single fams, JP Morgan, Invitation Homes, American Homes for Rent. They're building single family.
Dave, hang tight. You guys got 2 minutes now. Just in the interest of time, I want to be respectful of your guys' time and everybody else.
To Tim Brazza's point, I mean, the reason that's such a good play, I love the deal that you're doing, what you're doing with the townhomes. I think it's great. I got it, Alex. The reason it's such a good play is because they're individually parceled, just like a package of single family home would do. It creates more options.
All on site.
You totally gave him that opening, Tim. I mean, it would make an awesome 82-unit complex.
The reason it's a good deal is because it is parceled individually, like a portfolio single family home. That's the whole argument. You just solidified it for us.
You can only do one. I can do both.
Sure. No, I mean, you can do it with building single family homes too. It's the same thing. Buy the land, like Rod is saying. Why not? What were you going to say, Swanson?
There's a reason you're parceling them individually.
Correct.
Because having individually parceled and owned units gives you a ton of flexibility, gives you a ton of exit strategy, gives you a ton of bundling and packaging options, gives you greater financing control, gives you all the benefits that Dave and I have been talking about for the last 90 minutes.
So what's easier though? What's easier, doing 82 houses or 82 townhouses in one one location, and then you've got, yes, the multiple exit strategy is brilliant, Tim. It's awesome that you did it that way. But what's easier to do? Here, that's the question.
Who's to say? I mean, why is all the big money, big Wall Street money doing this with single family houses and not apartments and not
trust me, they're doing apartments
why?
too.
Why? They spend millions of dollars in research and data because the demand is in
every asset class. They're doing every asset class. They're not just doing houses. Trust me.
We already talked about the statistics. I mean, the multifamily, nobody's
all the
building
things you guys are saying that single family outweighs multifamily. No, I can do the exact same things that you guys are doing. So multifamily.
But there's way more demand for the single family. You're doing it in the multifamily type of structure.
Where you're investing.
Well, here, we
can sell them off houses outside of Savannah, Georgia, where there's massive demand.
Rob, wrap it up in 20 seconds on your end.
I'm gonna wrap it up in 20 seconds. According to the way financing is structured, a single unit, a duplex, triplex, fourplex is considered single family. 5 units and up is considered multifamily. So if we're building 100 individual units on one parcel, what we actually have built is single family at scale. We didn't build multifamily. We built single family by the definition.
Tim, Rod, take us home on round 5. Your rebuttal, 2 minutes.
Well, I'm listen. Kudos to you, Tim, for structuring your deal that way to give you flexibility. But the bottom line is, you're doing it all in one location. They're all the same. The fact that you're able to do it for $75 a square foot speaks to the fact that you're doing it like that. It's not a single family play. It's a 82 unit complex that you have the ability to parcel if you want. I doubt that you will. You'll probably rent them out and hold it forever.
Exactly. And let's also talk about construction from a renovation standpoint. From a renovation standpoint, I have, I don't know. I don't even know how many units, but let's say I have 200 units on a building that we're finishing up renovations on right now in Oklahoma. Guess what? We have shipping containers of cabinets that get delivered to one site. And as we turn units, they go and grab the cabinets and they put them right there and they grab the cabinet. There's no delivery to 100 or 200 different locations. Because of that scale, because of going to one site, I can hire one single project manager to just show up. And I don't even need to. I have a joint venture partner who has a little bit of equity in it. And then my on-site property manager is right there all the time. As an accountability partner, because they're all in one location. It's easier to manage. It's easier to construct. I'm working with people who have 10 million, 20 million, $100 million companies, and they understand not just how to swing a hammer, but also how to balance a budget, how to have their own accounting, have their own bookkeeping. They have their own administrative staff. They're accountable, right? Like if they're showing up and they're professional enough to walk out of their truck with a clipboard and pen and paper to actually take notes and listen and write down what I'm saying, that's the guy I want to be working with.
Or an iPad.
The quality people, not the cheapest.
Right. Or an iPad and it's all electronic. Much easier.
D.R. Horton.
Last 15 seconds, Dave.
D.R. Horton, Pulte Homes, KB Homes. Like, what do you think they do? They're doing exactly this. They're delivering everything in a giant container, the whole thing. But now the trend is to build to rent. In fact, it's been going on for years, build to rent. That's exactly what American Homes for Rent is partnered with Chase Bank. They're building communities to rent. What do you got, sponsor?
Hey, Alex, give me 10 seconds because I'm going to bring this home for everybody watching this. I think what Tim just said is probably the best thing that could have been said on this show. And I'll tell you why. We're all real estate guys, and we're trying to make cases for this asset being better than that asset. But you know what he just did? He just brought the two assets together in an example of how to do it, where you get the benefits of single family that Dave and I have been pushing. You get the benefits of multifamily that Rod and Tim have been pushing in one strategy. If the listeners take away from this all of the various things that we've been talking about and then listen to what Tim is doing, like it's the merging of the two worlds in a way that is like, hey, there's how you get both. Like if people walk away from this,
so Tom Hardy has the best asset class out there. We both lose.
That's right.
Hey, you guys are awesome. Before we move on to the bonus round, for everybody watching, hopefully, I mean, I got pages of notes here and I'm like trying to moderate and also listen and learn at the same time. You guys, I can't thank you enough on behalf of everybody watching this. You guys are thought leaders. You guys are badasses. You guys are rock stars. Really appreciate everything you have shared. I know you're inspiring a lot of people. Guys, before we move on to the bonus round, and I'm going to reveal what that is. This is all in an effort to, again, educate, inspire, entertain, have fun. We want to raise some money for a great cause. I've been associated with a charity called Graces, which essentially helps impoverished children and families that live in Antigua, Guatemala, part of La Escuela Integrada. And when COVID hit, these families went from earning $277 a month, $277 a month, to $186. So if you guys can find it in your hearts to just make $1 donation, $5 donation, $100 donation, whatever you want to donate, head over to reidebate.com. You can opt in, download your resources. There'll be a link for you guys to vote on single family, if you think single family won the debate, or multifamily, or you can text the word single or multi to 567-472-2371. So
question for you. How much of it goes to the people?
100% of it.
All right. Count me in for a grand.
Wow.
And also,
thank you, brother. Appreciate that, man.
Yep.
Guys,
flip more houses, and then after Dave flips more houses, then he'll have $1,000.
wow.
I gave 3,500 to the last Pardo fundraiser here, so
Yes,
I'm a giver too, man. I love Alex Pardo's gifts.
You guys are amazing. Bonus round here. I haven't prepped you guys for this, but at the end of the day, I think we're all in agreement that people watching this, people that are going to watch this in the future, listen to this on the Flip Empire show, they want freedom. They want to spend more time with their family. They want to do the things they love. They want to do what they want, when they want, with who they want, how they want, for as long as they want, all that good stuff. So it all boils down to which business provides the best opportunity for them to have that freedom, right? To build wealth, to generate cash flow. I think you guys have made clear cases for both single family and multifamily. So I don't know that there's a right or wrong. I think people watching and listening to this have to decide what's best for them. But here's the question to the bonus round. When it comes to building wealth, make a case why your side is better for the masses. And we're going to go ahead. Multifamily is going to start this one.
Go ahead, buddy. This is.
Yeah, well, I think there's a couple things. First is there's just more revenue streams, right? In single family, you have rent coming in. In multifamily, you have laundry income, you have storage income, you have parking income. You can put cell phone towers, you have garage, you can have signage, you can have valet trash vending, all sorts of different other additional revenue streams. And it's easier to reduce your operating. Well, maybe not easier, because single family, if you rent it, maybe the tenant's taking on all the utility expenses. But
we're talking about freedom.
Right. It's easy to scale because of the scale. I'm going back to scale, right? It's easy to buy an apartment building. And because of how many units you can accumulate in a very short amount of time, it's easy to take that residual income that apartment creates and layer it with passive income and bring on A players to help with management, to do the things that you don't like to do the things that you're not good at, to bring on a partner where if you're carving up 20 grand from a single family house, nobody's excited about that, right? You can bring in 4 A players, like, dude, what am I? I'm not doing this, right? I'm a multi-6-figure talent. Okay, well, in an apartment building, when you're carving up $3 million of equity in a single deal, you can bring in 4 different partners and everybody increases their net worth by 750 grand from that one transaction. And now you have people who complement your strengths on your team, doing things better than what you can do at the things that are drainers for you anyways. And you can focus on your driver activities. Like, I can go and travel anywhere around the world. I was in Spain for a month last year, my brother's wedding, and we closed on 400 units because my team took care of everything, because there was enough juice in the squeeze of those 400 units where I don't need to own 100%. I'd rather own 25% of a watermelon than 100% of a grape.
Yeah, let me add to that. Again, we're talking about freedom, time with family, and single family. Again, I've done 2,000 of them. Is a job. Maybe not on the scale that Rob and Dave do it, but on one-offs, to get to 20, 30 doors it's a job. And is it a great way to make some quick money? You bet. If you haven't got a pot to what in, then do some flipping and wholesaling and get some money raised. But if you really want financial freedom, there's nothing better than multifamily because of the amount of the lack of. How do I want to describe this? It's easier long term. Yes, you've got to buy the asset. You've got to sometimes renovate the asset and get a good management company in there, or you could manage it yourself, I suppose. But then you're just managing the management company if you hire a third party property manager, and so it's just less work. And so I mean, again, ask me how I know. I know because I learned by doing it, and so. There's nothing wrong with flipping and wholesaling. Listen, this has been a lot of fun, and it's a great business. I started there. Every one of my hundreds and hundreds of students, just damn near every one of them started in single family. But again, like I said when we started this thing, you don't see people go from multifamily to single family. It's always the other way.
And that's the point. If you're looking to continue your journey, maybe the easiest to get into is single family. You could, I'd say, just as easily get into a 5-unit apartment building as well. And get started and cut your teeth on that. But everybody, as you continue to grow and you go from broker to wholesaler to flipper to turnkey owner, buy and hold, single family, everybody wants to get into multifamily because it's easier to manage. You build more wealth that way, more equity that way. It's more scalable. It's easier to own. It generates more revenue. As you increase your net worth, the safety net increases with it because it's all non-recourse debt that you have in place.
Yeah. Let me add one thing here. One of the free resource that I added was a list of questions you should ask if you're going to get into a partnership, because this is a team sport, and it's like a marriage. Partnerships are easy to get into, but hard to get out of. And multifamily really is a partnership team sport. You're going to want to align with people. That's how you get scale. And to Tim's point, I'd rather have 50, 20, 30, 40, 50% of something over 100% of nothing any day. And so, but I'll add something. I just thought of something I should have probably done in that place. I'll add a tool book that I have that's 70 pages long, and I'll add it to the mix here. It's if you text the word ROD to 41411, I'll give it to you for free. It's 70 pages, like a due diligence checklist on steroids, and I'll throw that into the mix too. Yeah, in fact, here's a copy of it here, and it's 70 pages. No fluff, nothing to sell there. It's just like a due diligence checklist on steroids. It kind of walks through every step of doing a multifamily deal. We use it. It's every possible question I can think of. But the point is, listen, they're both great ways to make money. I just, for me, if you've got kids, you want to have a life, I think ultimately you're going to want to get into multifamily. Nothing wrong with starting with single family. These guys have built it into these big companies, and they're very, very successful at it. But, I would say that's not as common as somebody that buys 5, 10 houses, maybe 20 houses, but then they come see me and or Tim and learn this business, this multifamily game, because of the scalability, which, like Dave said, is probably one of the biggest advantages.
Yeah, I think you figure out what your destination is. Once you know what your destination is, then you can reverse engineer the path on how to get there, right? You know where you're starting, you know where you're going, then you create the path. Single family is a great way to get started. If you're looking to get going, I would definitely connect with these guys. They obviously know what they're talking about from a single family standpoint. And when you're when you're ready to go to 202 level, then you hit up Rod, you hit up me, and you can do both. I mean, there's so many ways to generate wealth in real estate. As long as you're doing real estate, you're doing the right thing.
Yeah.
So Rob, Dave, take us home in the last 5 minutes here.
I'll start, then Swanson bring us home. Yeah, definitely hit up Tim, hit up Rod. Don't hit up Grant Cardone. I will publicly say this, debate that clown because he does bad deals. But what we're talking about is freedom in this final round. And, freedom for a lot of people, scalability was the biggest point that we discussed from the very beginning on the multifamily side. A lot of people, for that freedom, they don't need 4,000 units. They just don't. And for the time with their family, another thing that comes with freedom is peace of mind. And I think the position we've taken when it comes to single family, the safety net, we've been arguing is really really the biggest with single family, simply because the number of different exit strategies. If you got to get out of a deal, if you're just getting started, same with the financing and the private money, everything, the safety net's really built in, everything we've been arguing, and that comes with freedom as well, right? So freedom is not always just, how fast you can grow something. Freedom also is that peace of mind for your family. I mean, shit, if you got a family, you don't want to risk with multifamily scaling too fast. It could be a good thing, but it could also be the biggest detriment to someone's family and freedom. Swanson, what do you got?
So the question was about freedom. The question was for the masses, the greatest wealth builder for the masses. And I think about how difficult it is to get the masses to do anything, right? Because the masses don't want to work. So to Tim's point, he said, figure out what your destination is and where do you want to go? Because with scale comes responsibility, and responsibility to more people, responsibility to a bigger team, responsibility to more investors, a larger equity of a group of capital. And so ask yourself, what do you really want? Do you need 4,000 units? Or do you need 30 units? Or do you need 10 units? What is the goal that you're looking for? And do everything that you can to go get that. We've talked a lot about it. Single family has been called flipping and wholesaling. That's not what I'm standing here talking about. I'm standing here talking about building wealth and residual cash flow through the ownership of single family home assets. And Rod said that you don't see multifamily investors going to single family. 12 minutes ago, Tim did. And so, I think that if we merge those strategies together, everybody can get the best out of real estate and what real estate has to offer. The thing that I'll leave you with, Alex, is this. What is the best one? It's the one that you'll actually do and follow through on. Like if you'll go to Rod and if you'll go to Tim and you'll learn their strategies and you'll implement it, real estate investing will change your life. If you talk to Dave, if you talk to me, you implement the strategies that we teach. And by the way, I teach a course on new construction scale, exactly to Tim's point. Because if you will go and ask any of the 4 or 5 of us, Alex, you're a very talented real estate investor. Ask any one of the 5 of us how to do it. We will probably give you the 3, 5, 7 steps that we would tell you to go do to make it happen. Now, 95% of you won't do it. The 5% of you that will do it will have results if you follow through. So regardless of which is better, the one that will build the most wealth for you is the one that you will do and the one that you will follow up on.
I love it, guys. I love it.
I've got a rebuttal. I just.
Of course you do, Cleve. Of course you do.
That was the biggest bring it home for the benefit of the people we could have done as a team, and you've got to rebut that.
I kind of feel the same way.
Rob, I loved how you ended it, but I to say that single family is safer than multifamily, I just can't let that go by, because single family is what killed me in 2008 at a 30% loan to value. Okay, I only owed 30 cents on the dollar. So, it's right, Stephen. Like you just said, it's the one you actually do. And Rob, thank you for sharing that. But I'm not going to let that slide by, because multifamily, I believe, is much safer. But again, it's whatever you end up doing. Bottom line, they're both good.
Yeah. What meets your ambition, right? Like what meets your long-term goals? Right. As long as you do that, then you do it.
Yeah.
You build a lot of wealth in both of them.
Ron, you said that there's nothing better than multifamily. If anybody wants to know an asset class that I think is even better than single family and multifamily, they can talk to me about that.
Oh, he dropped a teaser on us.
Bitcoin.
Really appreciate
Bitcoin. Oh, please stop. Okay.
Here's what we're gonna do. We got again, I just want to be respectful of everyone's time. Right. I carved out 2 hours to 2 hours and 5 minutes.
Yeah, I've got a hard stop in 12 minutes. Forgive me. But
there you go. So we're gonna move into Q&A, guys. I'm going to go ahead and seed it because I appreciate everybody on social media who has asked a question. We will not be able to get to all your questions, but there's been a ton of questions already on here. So if you have a question, fire away. We'll try to get to it. Try to be somewhat rapid fire, guys, but give us enough meat on the answer. Dr. David Phelps, mutual friend for, I believe, all of us. Here's a question. How many business cycles have you gone through in your current model? By the way, this question is directed at anybody that wants to take a stab at it. How many business cycles have you gone through in your current model, either multifamily or single family, not real estate in general? And assuming at least one, what lessons did you learn and how are you applying those lessons to today's market?
I'll learn real quick what I learned from the 08, and I think all of us went through it. You know, we've heard a lot about our stories and whatnot, but I learned to not be a speculator and to go for cash flow, and that's what I think we all stand for. Now, don't be speculation.
Cash flow is everything.
Cash flow.
Cash flow is everything. Bottom line, leave it at that. That is the answer. Focus on cash flow. Values out the window. Doesn't matter. How well does it cash flow?
Okay.
Always buy at a wholesale price. Create appreciation through sweat equity. Never speculate and buy for cash flow.
Yep. Love it.
Well said, gentlemen. Thank you. Mr. Mike Neubauer, a good buddy of mine. Barrier to entry on the multifamily with capital is tough to overcome. How do you overcome that barrier to start doing deals in the millions without $1 million in your bank account?
Because it's a team sport. You can raise them. You can raise every aspect of the business. Yes, you have to know it. You have to learn the business, build your competence. That'll equate to your confidence, which will equate to your ability to influence. But you know, the beautiful thing about this business is it's a team sport. So you can raise the money, like I said, for the earnest money. It's called the at-risk capital. The earnest money, the third-party reports for the financing, the due diligence costs, and they get a slice for doing that. You can raise the equity for the deal. We raise the operating expenses for the deal. And so you can raise that money, but you've got to know it, obviously, so you can speak congruently and have the ability to influence. You can't do it day one. You've got to learn the business. But that's the beautiful thing about this business. Yes, multifamily takes money, but it doesn't have to be your own money. And so,
hey, you come across a deal and you need money, hit me up.
There you go. Yeah, same here.
Next problem.
The gift that I gave a private money course of an hour long, on how to raise money. It could be applied to multifamily just as it could be applied to single family and how to approach an investor. And Rod hit the nail on the head. Get yourself knowledgeable, and it'll give you the confidence to get out there and raise money.
There you go. All right, gentlemen, there's a lot of comments in here, guys. So thank you for Joe McCall. Love this. Appreciate the love, Joe. A lot of questions here. Let me see here.
By the way, guys, text Rod to 41411 and get that book if you have any interest in multifamily at all, please, because it'll really help demystify the whole thing.
Yeah. By the way, gentlemen, one quick plug. Make sure to head over to reidebate.com. Tim has given us an awesome due diligence checklist. Rod with his questions about what questions are forming a partnership. Rob Swanson on reviving dead leads. Dave Pearson just newly created a video on raising capital. A lot of valuable resources that can help you guys, whether you're a single family investor, multifamily investor, all 100% free. The only thing we ask is that you make whatever donation you'd like to make. Stuart Fox, gentlemen, assuming each side, this is an interesting one. Assume each side bought 50 units in the same market, in the same area, and that market was appreciating. How much more equity would the single family guy that has 50 houses have compared to the guy that bought 150 unit apartment building?
Let me jump on that one real quick. None of us would buy for the value. We buy for cash flow, not for speculation. We've already established that. We wouldn't buy it.
Right. So hang tight one second. Let me finish the question. Of course, this assumes that both sides bought at the right time, the bottoms of the cycle. So
there's so many variables. Is there a value add opportunity? Can we increase the net income? Because any increase to the net income is an exponential increase to value. Okay, we've got one asset in Ohio. We're raising the rent $650. It's 100 units. That is a $12 million increase in value the minute it's done. So again, and that's an extreme example. That's not normal, but I wanted to give you an extreme example. So any increase to the net income. So there's a lot of variables. That's very hard to answer.
And I think one of the things that Rod didn't say is even if he's not in an appreciating market, because he can increase the net income, he's creating appreciation. He doesn't have to speculate. He doesn't have to wait.
It's not based on comparable sales, and that's the one
making it happen.
Yeah, it's not based on comparable sales. That's the one drawback with the other camp.
Single families valued based on comparable sales of what did the house down the street sell for.
But the way you buy it could be based on cash flow. We buy it for cash flow too.
Valued based on the income approach, which is what is the net operating income that the property produces. And if you can increase the income and decrease the expenses, then you increase the net operating income. and the multiple that the property sells at.
Rob,
So
that's the answer. Swanson is the
Yeah.
answer. 23
I did the math, guys. It's $23,566,213.
Yeah.
On what?
Elaborate, Rob.
That's how much more it goes up. No,
That's how much
joking.
more the single family guy has than the multifamily guy.
Oh,
I did the math right down to the
Yeah.
dollar.
You need to get a new calculator.
The first point I made was none of us would buy for the speculation. I mean, we've all learned that from the last question. You know, we would buy for the cash flow too. You're considered, and Tim, the way you're positioning, we buy for income, you guys buy for based on comparable sales. But if you're buying the asset, whether it be a single family home, if you're buying it with the intention of renting it, you're buying it for the income as well, right? So every one of us is all about buying it for the cash flow, not speculation. And then the guy's question, buy it at the right time. It's always the right time. I mean, if you're competent, you know what you're doing, you have good mentors, get out there and buy for the cash flow, and you're going to be fine.
All right, guys. Last couple questions here as we wrap up. I know Rod's got a hard stop.
Because I can't grow one, Joe. I can't.
Yeah. Tim, what's the deal? I got a beard. Rob, Rod, Dave, you're the only one without a beard, dude. What's going on?
I specifically shaved this morning because I thought that we would want to look presentable for this thing, and you guys just rolled out of bed.
I love it. I love it. All right, here's a good question, guys. I'm gonna ask this question and then one more. Josh Bacon, when you first started on your journey to building wealth, journey to building wealth, did you prefer using debt or cash? He's talking about on the acquisition side to build your portfolios, and what are the pros and cons do you guys see on both strategies?
I mean, leverage is the key. The only way to grow a portfolio, whether it be single fam, multi, anything, you can't save your way to riches. You're going to be waiting a long time. You'll never buy your first deal. So I think I'd like to hear what the other guys think. But I mean, without the use of leverage against real estate, that's the benefit of doing real estate. You can borrow money to actually buy assets. That's how we started this conversation.
So I'm not part of this debate, Dave, but I think I'd push back on you. I know quite a few guys that have pretty large rental portfolios that they don't have a penny of debt and they didn't start with debt.
Sure. I mean, but I think at some,
Well,
I
they
don't
had to
know
have
how
money
you
to
would
start.
buy it. They paid off the debt. At some point, they had debt. They started with, what did they save their way and bought a house? And, I think that's essential if you're trying to build any sizable portfolio.
I think maybe clarity on the question has to come into play. When you talk about debt, what are you talking about? And I get debt is debt, but there are different terms that go along with debt that are important in the answer to this question. Yeah. And so private money debt is what I would suggest everybody go do to figure out how to get started and build their cash flow. I'm not a big believer in debt. I don't like having a bunch of debt. I saw a bunch of people get their butts handed to them in the last crash because of debt. And so do I use private money debt today? Do I use some non-recourse debt in certain scenarios? The answer is yes. But it must cash flow. It must be bought right. The terms of the debt better be right. So I have a hard time when I hear people say the benefit of real estate is leverage, because that misleads a lot of people. And what they miss in that equation is the analysis of risk. Debt inserts risk into the equation, and you better understand the worst day of that debt risk if you're going to use it.
Agreed.
And that's regardless of what kind of asset class you're in. Because,
yeah, absolutely.
I mean, it can be used as a weapon for good or a weapon for evil. So,
hey guys, unfortunately, I got to use the restroom before my next thing. So listen, it was very much a pleasure. I'm 60. I'm old. I got to you peel up. Anyway, guys, it was very much, brother. Thank you.
Thank you, man.
All right,
guys, we're about to wrap this thing up anyways. I just want to personally thank Rob Swanson, Dave Page, and Tim Rod Cleave. You guys are awesome. You guys are amazing. I chose you guys for a reason. You guys have played all out. You've had some fun smack talking. You've educated, inspired, and entertained us. Just a big debt of gratitude. I genuinely appreciate you guys. Love you guys. And for all of you guys that have taken the time to watch this, it's been 2 hours in. For those of you who have opened up your hearts and your wallets and have made a donation, I don't care if it's $1 or $1,000 or whatever. I appreciate it. It's not going to me. This is going to impoverished children in Guatemala who don't have 2 pennies to rub together. And we're so blessed and fortunate that we're here, having fun on a Facebook Live and we have the ability to amass wealth and create cash flow and help and teach others how to do the same. So again, I'm just humbled. Thank you guys for tuning in. I'll kind of kick the last word over to you guys if you have anything to kind of take us home with.
Just gratitude, man. Good to see. I consider, somebody had commented earlier, is like, did I just hear from Dave that he took classes from Tim? The answer is yeah. I've learned a lot from Tim Rotz. He's somebody I confide in. He's somebody that I personally, we deal with haters in the social media world, stuff like that. Somebody's given me flack. He's somebody who would stand up for me, right? And so, yeah, I mean, grateful to be here with people I consider friends and confidants, and I would do it again in a heartbeat, man. I'm glad it's for a good cause. And, I'll go for another 2 hours. I don't care. I'm not 60 years old like Rod Khalifa out there. I'm ready to go. So thank you very much for this opportunity.
Thank you, Dave.
Yeah, absolutely. Go ahead, Tim.
I appreciate you guys. You guys are all dear friends, and respect the hell out of you. So this was a lot of fun. I think you guys held your own far more than what I thought you would. So good stuff there. I mean, that speaks to you guys being amazing operators. So I think the big lesson is don't wait to buy real estate, buy real estate and wait.
That's it. Yep.
Rob?
Man, I think that's it. It's nice that Rod's not here, because now I can bring it home with like some power for the people, and he's not going to like derail it. So the thing is, guys, get involved in real estate. Go make it happen. If you're starting, start. If you're scaling, scale. If you're going to the next level, like learn all you can about all of the different asset classes. It makes you a better real estate investor. Okay? Never stop learning, and that's what I'll leave it with.
Thank you, guys. Appreciate you. Thank you for supporting the Flip Empire show. If you guys are not subscribed, I would greatly appreciate that. My goal and aim is to just add as much value as possible, help you. So if anything I can do, I'm a phone call, a text, or a message away. And again, thank you so much for the time. Love you guys. Signing off. Have a great one.
Bye, guys.
See ya.
Take care.